Finally, after 2 years of rapid increase, housing prices are starting to decline across the country. There is a mystery mass exodus of real estate investors, who over the previous 10 years have grown to make up a significant chunk of the market. And sellers are capitulating, in historic numbers. Analysts who are concerned about what will happen next are paying close attention to this sudden change in market perception by the so-called experts. You see, before the huge crash, it was around 20 years ago. Investors accounted for less than 10% of the market in 2008. Over the course of a decade, investors gradually increased their influence in the real estate market. By 2021, investors had purchased a record high, more than 20% of all homes sold in the United States. In some markets with active speculation, this number was even greater. For instance, in Atlanta, Georgia, more than 30% of properties were purchased by investors. We discussed how homes have changed over the past 10 years, becoming more of a traded commodity in one of our most recent films than protection. Investors have completely changed the market by introducing leverage and liquidity, which ultimately implies that things are going well, prices are rising more quickly. But what happens when things go wrong? As investors scramble to exit, the same dynamics that previously drove prices up quickly now work in the opposite manner. Today, investors are exiting the real estate market in historic numbers, which has caused a sharp decline in prices. Investor home purchases nationwide decreased 30% year over year in the third quarter, per a Redfin survey. The greatest drop since, with the exception of the second quarter of 2020, the Great Recession. Due to the start of the epidemic, investment activity fell during this time. Even worse damage has been done in boomtowns like Phoenix. Their investor purchases decreased by 50% on a yearly basis. As a demonstration of pure market panic by those with billions of dollars on the line, this has a significant impact on the market. Before we look at one specific disturbing case to put this all in perspective, if you're enjoying the video so far, kindly take a moment to hit the like and subscribe buttons. I'm hoping to surpass the 2,000 likes my previous video received, 1 through 3,000. Resuming with the example, a business named Opendoor is among the biggest single-family investors in America. One purported expertise is to buy certain residences using software or artificial intelligence, AI, and then sell them again a few weeks later. Remember that there are thousands of other mom-and-pop investors with considerably smaller portfolios, in addition to this one corporation and dozens of other institutional players in the market. 9% of all Phoenix postings that are currently active are owned by Opendoor. This is ludicrous because it indicates that they have substantial negotiating leverage in that industry. The rule in this country is that if you purchase more than 5% of a publicly traded firm, you must register with the SEC and adhere to a number of additional regulations. But if you own 10% of a big city, you are free to do as you choose. This results in ludicrous price growth, or at least influences it. Phoenix's median home price, which was $275,000 in January 2020, increased by 70% to $474,000 earlier this year. Of course, it's not simply that investors are responsible for this quick growth, but because of their excessive greed and access to capital, there is a clear correlation between investor share and boomtown. Wherever there is significant institutional ownership in the US, there is also a ton of speculation and uncontrollable expansion. The market has altered since 2008, as I mentioned earlier today. What does all of this have to do with a crash or downturn then? While everyone loves to think that these multi-billion-dollar firms with complex algorithms know more than everyone else, they actually couldn't be further from the reality. Today, the big Wall Street investors are a substantial power in the markets. Like everyone else, Wall Street is perplexed by one of the most important downtrends in American history. Their algorithms are optimized using data that only considers events that occurred after 2008, a period of time marked by low unemployment, low interest rates, and consistent housing expansion. It disregards the numerous hazards that the market hasn't faced in years. Companies like Opendoor are learning a hard lesson about how to make money flipping houses when prices are declining by thousands of dollars every month. The stock price, which is down more than 95% from its high, serves as a representation of this reality. Their earnings report from earlier in the month made clear just how little they know about how markets would develop. The corporation itself acknowledges that the housing market will probably only grow worse, stating that we haven't seen U.S. home sales go below 4 million units a year in decades. The reality about Opendoor and all the other institutional buyers is that they are in a panic and are trying to get rid of inventory as soon as they can. This isn't just a theory. Their CEO missed this statement. I just wanted to point out that other iBuyers have only sold 40% of the inventory they purchased in Q2, while we have sold 67%, giving us a significant lead in liquidating our stock. This entrepreneur boasts that his company is growing faster than its rivals, even though the entire business model is shifting. Opendoor is transitioning to becoming less of a flipper and more of an aggregator of listings and data. They are now competing to survive and sell off their inventory as quickly as possible, not to buy more homes and improve margins. Consequently, it can be claimed that the market has never seen anything like this. Our investor market share is at an all-time high, and yet they are simultaneously unloading their inventories. Demand is also dropping off a cliff on top of that. According to the argument, there was a new wave of people forming new households following the epidemic, and many of those who were living with their parents or roommates throughout the lockdown left. As a result, we are currently witnessing a rapid decline in population. A never-before-seen situation is being created by this, along with high borrowing rates and prices that are 38% more than they were prior to the pandemic. The greatest loss in U.S. pending home sales history occurred this morning, falling by 37% year over year. Furthermore, this time period is beginning to resemble the one we experienced 14 years ago. While bad loans were the problem back then, today's dilemma could take the form of a perfect storm, a weak economy that collapses demand, and institutional retreat. It's expected that many of you who are watching this film will exclaim, "There is no crash." Prices are still higher than they were in 2019. We still have a long way to go before this becomes commonplace. However, the home market almost never plunges off a cliff, as was the case last time. It bleeds slowly and takes years to finish. For instance, in a boomtown like Phoenix, housing values did something amazing during the most recent recession that is hardly ever discussed. If we examine home values during that time period, we can see from this chart that they peaked in the fourth quarter of 2006. Following the start of the decline, they declined for more than 18 quarters, or 54 months, or 4.5 years of decline, before they finally bottomed out in the summer of 2011. In fact, if you had been the world's unluckiest buyer and had purchased a property in the winter of 2006, it wouldn't have been until the summer of 2019 that your equity would have recovered. That's more than 13 years of waiting, which just goes to show how slowly things move in the real estate industry. The effects of the damage take months to manifest, and recovery often takes even longer. Now that we know this, there is another significant element that will exacerbate this downturn. Real estate investors, as you may have seen, use a concept known as the cap rate to estimate how much money they may expect to make annually, given their investment. Currently, cap rates range from 4 to 10% on average. And keep in mind that investing in residential real estate isn't exactly risk-free. It's a wise investment, but as you're about to discover, there is another option that under certain circumstances is even better, one that rivals the real estate market, front to front. We are aware that the risk for good properties decreases with property quality and tenant dependability. Cap rates are at the lower end of the risk spectrum, and as the Federal Reserve raises rates, bond yields are rising to the point where real estate investment is beginning to be disrupted. There are no logical individuals or organizations that will invest in real estate when they can easily buy bonds and obtain comparable returns without any of the hassles associated with house investments. The 5-year bond yield is at 3.68%, down from a high of 4.39% earlier this year. The higher the mortgage bond yield, the less probable it is that investors will be willing to invest in residential real estate. As this goes on, the complete withdrawal of markets becomes more and more obvious. If the Federal Reserve is unable to control inflation for whatever reason, it will be forced to raise interest rates even higher. At some point, bonds will then become more and more competitive with other types of investments. As I demonstrated with the Phoenix example, these cycles can last for decades, and every sane institution will seek to exit if bond yields continue to rise. This will drain money out of the real estate market, especially with institutional players who will have a nearly impossible agenda making money in a long downtrend. This scenario of a perfect storm is the reason why so many people are already leaving, and values have begun to turn around in a degree that we haven't seen since 2008. The truth is fairly easy to understand. If prices can increase by 15 to 20% in a year, there is no reason they cannot decrease by the same percentage in the same period of time. However, many people are quick to disregard this reality by claiming that prices still have a long way to go. As always, I appreciate your attention. If you loved the video, kindly click the like and subscribe buttons and leave a comment below. People who bought in the Phoenix market before the crash would be quite welcome to contact me.